Okay, so you want to own a warehouse business. You drive past industrial parks and see massive warehouse facilities. Amazon logistics centers. Third-party logistics providers. Regional distribution hubs. The buildings sit there, generating revenue day after day, year after year. A 100,000 square foot warehouse leases for $6 to $15 per square foot annually depending on location. That's $600,000 to $1.5 million in annual revenue from a single building. A 500,000 square foot facility generates $3 million to $7.5 million in annual revenue. The tenant pays for everything. The tenant pays utilities. The tenant pays maintenance. The tenant pays insurance. You just collect rent. It sounds almost too simple. It sounds like owning property that funds itself. It sounds like owning a warehouse in 2015 when e-commerce was booming, when Amazon was expanding at unlimited pace, when logistics capacity was scarce, and when anyone with land and capital was making extraordinary money. That is exactly the comparison people are making right now. The logistics real estate market is worth over $1.5 trillion globally. There are over 20 billion square feet of warehouse space in the United States alone. E-commerce growth has accelerated warehouse demand. Last-mile logistics has become critical. Companies need flexibility. Warehouse rents have been rising. Occupancy rates are high. Mega fulfillment centers are expanding everywhere. The demand seems endless and the opportunity seems obvious. But here's the brutal truth that almost nobody discusses openly. The warehouse business in 2026 is completely different from 2015. The economics have shifted dramatically. The gap between warehouse owners who are making money and those who are struggling to compete has become a chasm. By the end of this, you will know exactly where the money actually comes from, what's changed, what the hidden risks really are, and what separates the warehouse operators that thrive from the ones who are getting disrupted by scale, regulation, and labor dynamics they didn't anticipate. What a warehouse business actually sells. The shifting paradigm: people assume that owning a warehouse means you're selling space. You are. But that's not where the profit comes from anymore. If you're selling space at commodity rates, the margins are being compressed by megacore with scale. What a warehouse business actually sells is location, flexibility, service, and operational consistency. A tenant doesn't just need square footage. They need a location that connects to transportation networks. They need space that meets their specific operational requirements. They need reliable facility management. They need partners who understand their business. But here's where the economics have shifted seismically. Amazon and other megalogistics operators are building their own facilities. They're not renting warehouse space. They're building proprietary networks. They have capital. They have long-term planning horizons. They don't need to negotiate with landlords. They control their own logistics chain. This vertical integration has fundamentally changed the warehouse market. The tenants that remain are mid-market operators who need flexibility without massive capital investment. These operators have less negotiating power than the megacore but more bargaining power than desperate landlords with empty buildings. But here's the brutal part. Warehouse rents have appreciated significantly from 2015 to 2026. What rented for $6 per square foot now rents for $12 to $18 per square foot in many markets. Tenants are getting squeezed. When rents double, tenant profitability gets cut. When tenant profitability gets cut, tenants move or go out of business. The owner is left with vacant space that needs to be released at lower rates or sits empty, generating zero revenue. This is the risk that most warehouse investors don't account for until they experience it. The full upfront investment. What actually costs money. Everyone talks about acquiring the warehouse. Nobody talks about everything else that determines actual profitability. Land and building acquisition, $3 million to $50 million. A 50,000 square foot warehouse costs $2 million to $8 million depending on location. A 100,000 square foot facility costs $5 million to $20 million. A 500,000 square foot facility costs $30 million to $100 million. Location is the largest variable. Urban warehouses in supply-constrained markets cost more. Rural warehouses with lower demand cost less. Most warehouse owners finance 60% to 75% of the purchase price. A $10 million warehouse financed at 4.5% over 20 years is $600,000 per year in debt service. Capital improvements and maintenance reserve, $500,000 to $3 million new roofing. HVAC systems, loading dock upgrades, electrical systems, fire suppression, ADA compliance. Modern warehouses require substantial capital for compliance and operational standards. You need reserves for unexpected major maintenance. A roof failure on a 100,000 square foot building costs $200,000 to $400,000. You need to fund this from reserves, not from borrowing. Property management and operations, $200,000 to $1 million annually. Facility management staff, maintenance technicians, security, landscaping, cleaning, property taxes. Professional property management requires infrastructure. A 100,000 square foot facility needs 2 to 4 full-time staff members. Cost, $200,000 to $500,000 annually. Insurance, $30,000 to $150,000 per year. Property insurance for a large warehouse is expensive. Liability insurance, workers' compensation if you have employees. Tenant liability protection, specialized warehouse coverage. Utilities and infrastructure, $50,000 to $300,000 annually. Electricity for common areas, lighting, and systems. Water, sewer, waste management. Depending on climate and facility size, utilities can be significant. Cold storage facilities have dramatically higher utility costs. Capital reserves for vacancies and downturns, $500,000 to $3 million. You need reserves to survive periods of vacancy or reduced rental rates. If 20% of your space goes vacant and rents drop 15%, your revenue could drop 35%. You need capital reserves to cover debt service during downturns. The real total investment for a legitimate warehouse business, acquiring a facility and building operational infrastructure requires $5 million to $30 million in total capital depending on size and location. Most warehouse investors finance 60% to 75% of this through real estate debt. Where the money actually comes from, the economics that work once you own the warehouse, the revenue model is simple. Tenants lease space. You collect rent. But the profitability depends entirely on what you pay for the building, what you can charge for rent, and what your operating costs are. Revenue model: 100,000 square foot facility at $12 per square foot equals $1.2 million annually. 500,000 square foot facility at $10 per square foot equals $5 million annually. Simple. But here's where reality diverges from spreadsheets. The operating cost reality for a typical warehouse: a 100,000 square foot facility in a secondary market, gross revenue, 100K SQ feet at $12 per square foot, $1,200,000. Operating expenses, property management staff, $250,000, utilities, electrical, water, waste, $80,000, insurance, $60,000, property taxes, $120,000, maintenance reserve, 2% of revenue, $24,000, capital reserve for repairs, 3%, $36,000, landscaping and grounds, $30,000, security/access control, $40,000, administrative/professional services, $30,000, contingency/miscellaneous, 3%, $36,000, total operating costs, $706,000, net operating income, NOI $494,000, debt service, 20-year mortgage at 4.5%, $600,000, annual cash flow, $106,000, actual annual loss, $106,000. This warehouse generating $1.2 million in revenue is losing $106,000 annually. The model isn't profitable because debt service exceeds NOI. The profitability formula: when warehouses actually work. For a warehouse to be profitable, the rent must generate NOI that covers debt service with excess for reserves and returns. Here's the math that works. A 100,000 square foot. Alternatively, acquire a facility in an exceptional location where market rents are $18 to $20 per square foot. A secondary market where your facility is the only modern warehouse. You have pricing power. Revenue reaches $1.80 to $2 million. With operating costs of $600,000 and debt service of $600,000, you're netting $600,000 to $800,000 annually. What warehouse owners don't account for: the vacancy trap. The math above assumes 100% occupancy. Here's what actually happens. Market saturations and rent compression. New warehouse capacity is being built at record pace. Supply is increasing. When supply exceeds demand, rents compress. A market where rents were $15 per square foot drops to $12. A market at $12 drops to $9. Tenants have options. You're forced to compete on price. A 20% rent reduction cuts your NOI by 20%. Suddenly, the facility that was profitable is marginal. Tenant vacancies. A tenant's lease expires. They relocate. You have 90 days of vacancy while you find a replacement. During vacancy, you collect zero rent but still pay operating costs and debt service. You're burning capital. If you have back-to-back vacancies, your annual vacancy loss could be 10% to 20% of revenue. Tenant distress and defaults. A tenant faces financial trouble. They can't pay rent. You have to evict. Eviction takes 60 to 120 days. You lose rent and incur legal costs. If the tenant damages the facility, you're paying for repairs. A single problem tenant can consume $50,000 to $200,000 in lost rent and repair costs. Economic cycles. Recessions reduce shipping and logistics. Demand for warehouse space drops. Occupancy falls from 95% to 60%. Rents fall 20% to 30%. Your revenue collapses. You're still paying debt service and operating costs. You're losing money monthly. What's changed? The warehouse market in 2026 vs 2015. Labor cost inflation. Warehouse staff wages have risen 40% to 60% from 2015 to 2026. What costs $40,000 per employee now costs $65,000. Operating costs have nearly doubled for facility management. Regulatory burden. Climate disclosure requirements. Energy efficiency standards. Environmental compliance. Zoning changes. What was simple in 2015 requires expensive compliance in 2026. Add $50,000 to $200,000 annually in new regulatory costs depending on jurisdiction. Amazon's direct competition. Amazon isn't just a tenant. Amazon is a competitor. They're building massive fulfillment centers. They're undercutting warehouse landlords on price through proprietary networks. Their scale makes it hard for traditional warehouse operators to compete. Technology requirements. Modern tenants expect advanced systems. Climate control. Smart access. Real-time tracking. Energy-efficient systems. Building out these systems costs $200,000 to $500,000 for a facility. Operating and maintaining them adds ongoing costs. Supply chain resilience. Focused companies no longer want single warehouse relationships. They want multiple geographically diverse locations. This creates competition between warehouse owners. Tenants can shop pricing across regions. Your bargaining power has declined. The good scenario. When warehouse ownership works spectacularly, you acquire a distressed warehouse facility in a supply-constrained market for $4 million. The facility is 100,000 square feet. You renovate and modernize it for $500,000. Market rent is $16 per square foot. You immediately lease it to a strong tenant for $1.6 million annually. Operating costs are $400,000. Debt service on $3 million financed at 4% over 20 years is $180,000. Your annual profit is $1.6 million to $400,000. $180,000 equals $1.02 million. That's a 25.5% return on your $4 million investment. The facility appreciates 3% annually. Your property value increases $120,000 per year. Your total annual return is $1.02 million. Cash profit plus $120,000 in appreciation equals $1.14 million, or 28.5% return on capital. Over time, you pay down debt. By year 10, debt service drops to $100,000. Your annual profit increases to $1.1 million. You own a real estate asset generating genuine wealth. The bad scenario. The more common outcome: you acquire a warehouse for $8 million in an oversupplied market. Market rent is $10 per square foot, not the $12 you projected. Revenue is $1 million annually instead of $1.2 million. Operating costs are $500,000. Debt service on $6 million at 4.5% over 20 years is $357,000. Your annual loss is $1 million to $500,000. $357,000 equals $143,000. You're losing money every year. Property values decline 2% to 3% annually in oversupplied markets. Your $8 million asset depreciate to $7.5 million. You're losing money on operations and losing equity to depreciation. By year 5 you want out. You sell at $6.5 million. You've lost $1.5 million in equity plus $715,000 in accumulated operating losses. Total damage, $2.215 million. The hidden advantage of scale and diversification. This is where the warehouse business gets interesting. A single facility owner is vulnerable to local market cycles. A portfolio of 20 facilities across different markets reduces risk. When one market is weak, another is strong. You can manage capital across the portfolio. You can cross-collateralize debt. You have negotiating power with tenants and lenders. This is why institutional investors dominate warehouse ownership. They have scale. Individuals have vulnerability. What's changed that makes warehouses potentially smarter now than in 2015? Aging infrastructure. Many warehouses built in the 1980s and 1990s are now obsolete. New buildings are needed. The newest, most efficient facilities command premium rents. An investor who builds new can capture the premium rent and energy efficiency advantages. Older facilities are under pressure. Supply chain decentralization. Companies are decentralizing supply chains away from megahubs like Los Angeles. They're building regional networks. This creates demand for smaller, medium-sized facilities in secondary markets. An investor with a 100,000 square foot facility in a secondary market could have strong demand from companies avoiding megahub congestion. Last mile logistics focus. E-commerce is mature. Growth is slowing. The focus is now on last mile efficiency. This creates demand for smaller, distributed facilities. Urban warehouses for same-day delivery. Regional hubs for next-day delivery. The geography of warehouse demand is shifting. Real estate financing changes. Interest rates have normalized after years of historically low rates. Warehouse financing is now more expensive. This reduces the number of competitors who can finance warehouse acquisitions. Established operators with capital have advantages over new entrants. Conclusion: the actual economics of warehouse ownership in 2026. Owning a warehouse business is fundamentally a real estate investment with operational complexity. Profitability depends on acquisition price, location, tenant quality, and market dynamics. Get the acquisition price wrong and you're underwater for 20 years. Get the location wrong and you're stuck in an oversupplied market where rents are declining. Get the tenant wrong and you're dealing with problems for years. The money in warehouse real estate goes to 4 groups. First, institutional investors with scale and geographic diversification who can weather market cycles. Second, investors who acquire distressed assets in supply-constrained markets at deep discounts. Third, operators in high-demand markets where supply is limited and rent growth is consistent. Fourth, developers who build new, modern facilities that command premium rents from quality tenants. The separation between warehouse owners who generate wealth and those who destroy capital comes down to 3 decisions made before you buy. Acquisition pricing that's disciplined, not FOMO-driven. Location selection based on supply-demand fundamentals, not just positive development projections. Tenant underwriting that's rigorous about financial quality, not just occupancy rate. The warehouse that's profitable is the one acquired at the right price in the right market with the right tenant. The warehouse that's unprofitable is the one acquired at top of market prices in an oversupplied area with average tenants. The difference in outcome is thousands of dollars per month for decades. Here's what makes warehouse ownership potentially smarter now than in 2015. The easy money has been made. The opportunities for 50% returns are gone. But the fundamentals are solid. E-commerce demand is real. Logistics is essential. Companies need warehouse space. An investor who approaches this rationally, with disciplined underwriting and realistic return expectations of 8% to 12% annually, can build real wealth through real estate. But the fantasy of buying a warehouse and watching money flow in passively is exactly that, a fantasy. You need capital discipline, market intelligence, and operational sophistication. Get those right and warehouse ownership could be the smartest move you make. Get them wrong and you're spending 20 years paying a mortgage on a money-losing asset.